Day 513 of Going Live. Today, what we're looking at is we're looking at properties that are coming onto the market because we're trying to assess whether or not these properties are going to be a good comparable value for the BRRRR strategy. Now, what does BRRRR stands for? BRRRR stands for buy, rehab, rent, refinance, and repeat. And these properties that are coming on the market, we're tracking them, right? If you've been part of our lives for the past couple of months, you would see that we've been tracking properties that are sold by zip code, by bedroom count, bed bath count, square footage, year built, some specific details about your market, such as if you're in Phoenix, you might be looking at properties whether they have pools or not. In this area, we're looking at whether they have garages and basements, what subdivision they're in, and some general comments about their condition of the home, just by looking at the photos in terms of the kitchen, bathrooms, flooring, painting. Very simple stuff that you can see from the photos. Unlikely that you can see the condition of the roof, water heater, HVAC, unless you actually get someone out there. But that's why we're tracking down all these properties. Now, the whole point of the BRRRR strategy is, let's use an example. If you buy a home for $20,000 and you renovate that home for $50,000, now you're all in at $70,000, 70. Now, when you spend $70,000 all in, but you're able to make the property worth $100,000 through your renovations, which is what we call forced appreciation, you can now go get a debt service coverage ratio loan for 70% of the home's value. That allows you to go ahead and take back out 70% of the home's value in the form of loan proceeds, which means that for a home that's worth $100,000, you take back out 70 grand. So in that case, you're able to take back out all your initial invested capital from that single deal. And then you can take the same 70 grand and use it over and over again. That is the beauty of the BRRRR strategy because the velocity of your capital, right? Your ability to use the same pile of cash over and over, that's what makes that strategy so attractive to a lot of folks, especially investors. However, if you think about a strategy, what is that strategy really heavily dependent on? It's heavily dependent on you getting the ARV or the after repair value correct. Because if you don't, you're going to end up leaving more capital in a deal, right? If that home was worth only $80,000 instead of 100 grand, now you're only able to take off 70% of 80,000 instead of 70% of 100 grand, which means you'll be leaving in a lot more capital than you expected. Because what's the alternative? The alternative is you save up money from your full-time job for that first 20% down payment, and you buy that home, you hope it cash flows or appreciates, and then you gotta save up money from your full-time job all over again. And that's why it's a lot slower process. This home is writing down all these minor details here so that I can track all of them. As you can see, I've got the year built, I've got the price, square footage, listed a day ago, listed 22225. There a garage. There's a one car garage. Yes, one car, no basement, no HOA. Let's see what neighborhood this property is in. This property is closest between South Highlands and Southeast Lake. Between South Highlands and Southeast Lake. Great. Let's check the condition of this home. This property, if I were to look through the photos, I mean, it looks pretty renovated. Modern bathrooms, modern kitchen, unfinished garage, unfinished basement, and a deck and a pool. Wow. Okay, so this is a little bit above average in terms of you don't really see pools in properties that much. So above average modern kitchen and bathrooms, no painting or floor work needed. Huge patio with backyard pool. Great. So now that I noted all these details down, I now can reference another property. So let's say what's a perfect comp, right? If I had another comp and I was looking for the perfect comp, I would say, hey, what's the property next to it? What is the bed bath count? Does that have the same bed bath count, same square footage, same year build? And if it does, then I can use that for my square footage. However, that's typically not how it works for comps, right? When you cross big man-made borders such as I-59, right? These man-made highways, or big natural borders such as these mountains, these lakes, etc., you're in completely different neighborhoods. So that's why you got to pay really close attention to your comp. And if you don't get the appraisal that you're looking for, what are you going to do to challenge that appraisal, right? All right, so the next thing I want to do is right here. So let's analyze this deal as is on the market, right? For my renovation on this property, I am going to put aside 1,500 bucks for the roof, just in case there's anything wrong with it, in case I can't see it. 500 bucks for some landscaping. I don't need any painting work here. I got 2 bathrooms that I'll probably change the toilet to the higher pressure flush toilet, so I don't have any clogged toilet issues. Then I got a cage for my HVAC, just because I had a HVAC stolen recently, and I don't want that to happen to me again. So cage for HVAC cost me about 900 bucks. Great. So now that I got the number in there, I got about $4,600 rehab for this property. For my rent, I'm gonna go to affordablehousing.com. I'm gonna go to the owner section and go to the market rent estimator, plug in the address, plug in my account. And I can see that the average rent for 25 units within a 2.26 mile radius is 1409. Great. So let me put in 1400 here just so I can round easily. I'm gonna grab the taxes and my insurance right from my payment calculator. So I got $91 there. Obviously, you should double check with your county assessor records before you close. And this is 155 here. I'm assuming this 155 is for a property that is used as a primary residence. If I'm using it as an investment property, typically insurance companies will view your asset as a riskier asset. So that's why I'm adding a 20% premium by multiplying by 1.2. Then I got 10% set aside for maintenance every single month. I got 10% set aside for property management, and I got 5% for vacancy. So let's go to my down payment. In F19 is 25%. So my down payment is going to be equals to B4 times my 25%. That's 49,750 for my down payment. I got 2.5% for closing costs, the $4,600 of renovations that we talked about earlier. My finance amount is going to be equals to B4, which is my asking price, minus my down payment percentage in E19. So I'll be financing 149,250. I'm going to use a 7.5% interest rate right now for these numbers to calculate my cash and cash return. So if I rent this out as a 4-bedroom for 1,400, I would negative cash flow. So I'll be losing $271 a month, the negative 5.5% return. So we can buy this property for 199,000, and that's a rehab of $5,000 with a 25% down, 7.5% interest rate. Great. Next thing I want to do is, well, what do I need to purchase this property for in order for my cash and cash return in E9 to be 10%? Now, again, this is not investment advice. I'm not soliciting any investments on this call. Just simply showing you how to tactically put in the details in the spreadsheet so that you can figure out what's a deal for you. And if that number is 10% for you, right, at 100 grand, that's almost there, right? So at 95 grand, assuming everything else stays constant, 98,000, that will get you to a 9.9% return with a cash flow of 259 a month. This is when you buy this property for 98 grand with $5,000 rehab, 25% down, 7.5% interest rate. Okay. Now I'll go through one more thing. If you're paying attention to what the 30-year mortgage interest rates are affected by, right? It's heavily affected by two things. One is the interest rate on the 10-year treasury yield. And you can see right now it's at its near 12-month low, 12-month high of 4.42, right? It reached its peak at 4.8 just a couple of weeks ago. And just 3 months ago, it was as low as 3.6. And this is why you got to track what's happening to the 10-year yield, because it's affected by one, the interest rate here, and also two, the spread. Historically, the spread between 10-year yield and the 30-year mortgage interest rates has been about 1.5 to 2%. But we've seen it go as high as 3%. So that's when we saw interest rates in the eights, and that's when the housing market literally just paused, completely stopped. So this is going to be really important for you to track, because if you, regardless of what kind of politics you're in, right? If you just look up Scott Bessent, part of the Trump administration, Trump focus on 10-year yield, you can see that they are focusing less on the central bank, but more about bringing the yield on the 10-year treasury down. They don't ever want to exceed 10%, right? So that's why You have to pay attention to what they're doing instead of just looking at your typical headlines about, oh, the Fed's cutting rates, the Fed's not. It's the bond market moves much, much, much faster. And this is what drives the relationship with the 10-year, the 30-year mortgage rate. So if you're refinancing today, right, you might be looking at properties that were sold in September and October when interest rates were at the lowest, which means your monthly payment is lower. So that drives up your affordability and drives up the prices that properties typically close at. Versus now, right, if you're buying a property today and you're looking to refinance in 6, 12 months from now, you might be comparing values for properties that are sold today when interest rates are their highest, so your monthly payment are higher, and that puts downward pressure on affordability and the closing prices. So that's why you got to budget, right? You might be looking to refinance 70% of the home value, but you might be looking for, hey, maybe I should just try to do 60%, right? And that's what I need to buy the property at on a discount so that you can hedge and create some buffer for yourself because you're understanding what's happening in the market right now today. So let's do this, right? If I lower my interest rate right here to from 7.5 to 6%, right? See what happens in my cash and cash return number? It just went up by almost 3%. So this property that I would have bought $98,000 for to achieve my 10%, I can probably buy this property for $108,000 now. So because interest rates drop 1.5 points, right, from 7.5 to 6%, but everything else stays constant with a $5,000 rehab, 25% down, I can now afford to pay a full $10,000 more simply because interest rates fell 1.5 points. And that's the point I really want to drive home with you today. You have to understand how this relationship works and how it affects your ability to evaluate what's a deal, right? There's so many inputs, so many different ways to adjust your analysis. It's up to you to decide how to make it work, right? So my hope is this. I hope you copy my homework today, right? Analyze the same deal I analyzed today using the same spreadsheet. If you guys want to copy the spreadsheet, just go to affordablehousing.io, go to the Get Deal Analysis tool, plug in your name, your email, your phone number. That's the fastest way to get a copy of the spreadsheet, right? I didn't make the spreadsheet from scratch. I got it from a few other folks. I modified it to just so that I can analyze these deals as fast as possible. This one will differ for every single market you're in, right? You're just going to update it once you understand, hey, how much does it cost to replace the flooring in your home, right? That's all up to you. And my hope is this: you put this on your own YouTube channel because at some point someone's going to ask you, hey, why do you think this is a deal? And you can tell them it's a deal because you've been looking at properties for the past 513 days. Might that give you some confidence that you know what you're doing? I certainly hope so. All right. I hope you all have an amazing Sunday. Spend some quality time with your family and friends today. That's what life is all about. I'll see you all tomorrow for day 514. Have a good one, everybody.